Rob's Child. Nothing I say is investment advice. Welcome back to the series where we go through every chapter of Benjamin Graham's The Intelligent Investor. The book, in a link below, there's a PDF of it. My recommendation is read the chapter and review it with me and see how it might apply to things going on in 2024 and get some of my insights on how it might relate to the lessons that are from 1940 edition, second edition of Security Analysis. Let's jump right in. Today's chapter is Chapter 5, The Defensive Investor in Common Stocks. It's very important to note that this whole chapter is about the defensive investor. Sometimes we get lost in the words and assume that what he's saying is for everyone. Everything in this chapter we're specifically talking about the defensive investor in common stocks. First notable point, he mentions that from their 1949 edition, they made a case for a substantial common stock component in all investment portfolios. He mentions this mostly because, again, when he wrote Security Analysis, he mentioned in that book and in this book a few times that it wasn't considered to be safe investment to be in stocks at all before, I think it was the 1920s. That's when that really started, and really ever since the Great Depression today in 2024, common stocks have been considered to be absolutely necessary for any kind of investment portfolio. There's a footnote here that mentions, that reiterates, again, 20 years before 1949, the average yearly return was only 3.1% in stocks versus 3.9% in long T-bonds. I've been beginning to question this 3.1% return only because if you look at dividends alone, never mind capital appreciation price, from this chart that I found on the internet, it shows before 1949, around here where my mouse is, that the dividend yield of the S&P 500 never really got even below 3%. In fact, it's really ranged between 3% and 9%, making it seem like in dividend yields, maybe that would be around 5%, at least higher than 3% plus capital appreciation. So I'm not sure what's going on with this. If anyone has any other insights to how this works, please comment below. Again, the question is, before 49, was the total return really only 3.1%, or was it actually higher? Moving on through this chapter, he repeats, when stocks are high, they seem safe, when the opposite is actually true. They get safer the lower they go because they can only go up from there. Scrolling down, we have a footnote that mentions we never return to normal valuations of stocks, and it's still really true in 2024, and that's pretty evident if you look at PE ratios, especially. For the past 20 plus years now, we haven't seen PE ratios get below 19 of the S&P 500, not very much, not very frequently, and that just makes me wonder if we're in the greatest stock bubble of all time. Again, the price relies on other people buying it, not necessarily the intrinsic value, but it's just there's that much confidence that stocks will continue to keep earning more and more, and that current price will continue to be vindicated even though it seems high. That's where we are here in 2024. And I always wonder, is it possible to go back to valuations of the past where PE ratios really never went above 20 for the entire S&P 500, and going down as low as 4 in when stocks were not very popular? If we, for example, get to a period in 2024 where stocks become very, very unpopular, it's just not out of the realm of possibilities. That's my own commentary about that whole situation. I'm not actually going to bring up this dividend yield chart here, but as of June 2024, the dividend yield of the S&P 500 is only about 1.3%, never lower since right before the dot-com bubble, where it was 1.1%, and before then, we're clearly, to me, in a bubble right now. It's very clear, even on a shorter term time horizon, if you just look over the past 20 years. And so the question is, are we going into a period where 1% dividend on the S&P 500 is the new normal, and we go up and down between, I don't know, 0.5% and 1%? I doubt it. I think there's a higher chance of stocks returning to a more normal level. At the end of the day, people want return, and if it's depending on Ponzi scheme type of valuations of just we need more investors to keep piling in order to keep the price up, it's like it just feels so unsustainable at this point. But I digress. Moving on to the points of the chapter, he mentions a warning: when stocks are expensive, they can depreciate. He just talks over and over again in this chapter how when stocks are expensive, they're less safe, especially. The price can depreciate. They won't always depreciate. It doesn't have to depreciate, but it can. And it can do so more easily, especially when it's expensive. Anyway, moving on, I have a quote here: we feel that the defensive investor cannot afford to be without an appreciable portion of common stocks in his portfolio, even if he must regard them in the lesser of two evils, the greater being risks attached to an all-bond holding. And what he's referring to is, to always maintain never less than 25% of your portfolio in stocks, even if they seem expensive. So you can hate on stocks when they're really expensive, but he finds it very unwise to have less than 25% of your portfolio in stocks at any time, simply because earnings can catch up. Even if it's way overvalued, if the earnings suddenly go up and then the value goes up higher, you can have the earnings chasing the value going up. It's like not a very comfortable scenario to be in. We're currently in that scenario right now in 2024. The only way for our current PE ratio of 28 to make any sense is for earnings to keep going up, and then, and for the price to appreciate. Of course, in stocks, the market just has to believe that it's just going to keep going up, and it might. It might. So, like he says here, never less than 25%, even if you think stocks are crazy expensive. Quick reminder again, this is for specifically the defensive investor, and I'm very curious how this will be different in the other types of investors that we'll be going over in subsequent chapters. So then we have a section on the rules for the stock portion of your portfolio, whether it's 25%, 50%, or as high as even 75%. And again, remember, this is rules for the defensive investor. So for diversification purposes, the first rule is that you should have basically a hard minimum maximum of stock picks between 10 and 30. Never less than 10, never more than 30. More than 30 is too hard to keep track of. Less than 10 is not enough diversification. Second rule, large conservative capital structures only. He doesn't go into detail with that. He doesn't actually go into detail at all about what conservative capital structure means. All it really means is that the equity and the debt aren't overly leveraged. You don't want too much debt for the amount of equity, basically. And then third point here, that it needs to have, what he says is basically what comes down to a 30-year history of sturdy dividends. So that's one of the rules for stock picks for a defensive investor. I found that to be pretty interesting. And then, rule number 4, the maximum price should be 25 times average earnings of the past 10 years. So this is a lot more conservative I mean, no, this is a lot more liberal than what you find in security analysis from 1940. I don't think it was, he had it 25 times for these types of stocks. I believe it was 20 if I recall correctly. And so I think he may have gotten more liberal in this book regarding that. Of course, you know, if you're looking for something more interesting, you know, you use the much lower, much lower price earnings ratios for finding like potentially super undervalued, like, you know, the cigarette butt value stocks that he's famous for, you know, finding things that clearly have more value than the market says they do. And we're not talking about that right now at all. We're talking about large cap, big companies. This is what the defensive investor should have, he says. So, you know, 25, a PE of no more than 25, and for the past year, so you have to average out the past 10 years of earnings. You can do that today very easily, by the way, going to macrotrends.net. You look up a company's EPS, you can find it very easily. What I do is I just highlight the list of the past 10 years, throw it into ChatGPT, say average it out for me. They give me an average. And then, you know, that way I can multiply it by 25 to see if that criteria would work here. So very quick, very easy to do this today with computer technology. And then, of course, like this number is not like something easy to find. You do have to calculate it out, the 25 PE average earnings of the past 10 years, and then but also not more than a current PE ratio of 20. So the trailing 12-month PE ratio, which is a lot easier to find than past 10 years average earnings ratio. So he says that this way of buying things in 1972 when this book came out, he says that that's way too conservative to buy anything now, because basically everything had worse PE ratios, at least in that category, in this category of stocks. And but you know, he says that he has good reason to have this rule, and so it's interesting. He'd be mixed in this time. It's like it's pretty obvious to him at this time period in 1972 that everything was overvalued, and he turned out to be correct. There was a major correction that made things more normal price, but it doesn't mix with his 25% rule. If you have to have 25%, you know, what do? You sit on cash, you wait. I'm not sure what he would say to someone that just has a bunch of cash that they want to invest in this year. Moving on, we have a section on growth stocks and the defensive investor. And, you know, he defines growth stocks as a company with earnings growth above the common rate of earning growth. So anything where the earnings are going up faster than everything else around it, basically, that's considered to be a growth stock. He says it's complicated to price it, and yes, it sure is. As you can see, you know, growthy stocks today, even trillion-dollar growth stocks today, have a lot of trouble trying to figure out how much they're worth. The price just going wildly up and down. We're living in very crazy times in the stock market right now in June of 2024 at least. So, but anyway, moving on. So complicated to price examples. He has examples of companies with huge earnings and price growth, followed by huge earnings declines along with price. I always like to bring up NVIDIA at this time, only because their PE ratio is 75, and so that assumes that the growth of earnings it has to continue in order for that current price to make sense, never mind a future price. So yeah. Next big point made, the average investor is doomed to find a good price on a growth stock as money growing on trees. So, you know, if you're gonna be an average investor's chance of finding a growth stock that's going to make him rich. He says it's as rare as going out there into the woods and finding money growing on a tree. I love how blunt he is with, you gotta laugh out loud at a lot of his things. He does that all the time, security analysis as well. More so in this book, I believe, in The Intelligent Investor. He can't help himself. Moving on, again, for the defensive investor, large, unpopular, solid companies are best. So things that are potentially undervalued because they're unpopular. He doesn't like stuff that's really popular, because obviously when something's really popular, it's going to have a lot more value priced into the stock price than it probably deserves. And soon as it drops out of popularity, watch out. It can go down. Again, relating to 2024, the Mag 7, they have so much unproven earnings priced into the speculative price that they are at right now. It's insane. It's insanity. He would not be buying the Mag 7 with a 40-foot pole. That's pretty evident, as I'm reading through this chapter and relating it to what's going on today. Next, we have a section on portfolio changes. He actually suggests a yearly review of holdings by a large reputable firm. So, for your average investor, again, we're not talking about aggressive investors that want to perhaps take advantage of things that are mispriced. He's talking about your average person that just wants to perform well and be intelligent enough for the defensive investor. He advises that you wish to he advises that you, when you talk to your reputable firm, your advisor, the guy who buys your stocks for you, or tells you what to buy at least, he says, tell them that you wish to adhere closely to the 4 rules of common stock selection given earlier in this chapter. So if you own a stock that is getting super popular, you remember the 4 rules. You can even look back in this video and see them. So tell your advisor, I want to follow these 4 rules. That's what he says. I find that pretty interesting, and I find that pretty intelligent. I think that's a great way for more passive investors that don't want to seek out greater opportunities to be investing their stock portion of their portfolio. Next, we have a section on the all-famous dollar cost averaging. Now, he does note here, he criticizes it to some degree, but ends up concluding that it is a viable way of investing. But he does also note that it is a formula type of investment, and whenever you use formulas to decide what you're going to invest, that's what traders do. They use patterns, but over again a long time period of 20 years, you're generally going to be performing very well, but again, not always. And that's the big thing for me about this. But anyway, he questions the statements about this, how solid it is. In other words, again, it's solid, but it's not foolproof. Remember, Graham knew very well what happened in 1929, the Great Depression. So, basically concludes that dollar cost averaging is viable. But he doesn't go into it really much past this. He doesn't seem to promote it. He just kind of says that, it's okay. Which I think is interesting. Next section is on risk versus personal situation. Basically, how much risk should different people take depending on your situation. And basically he concludes that a defensive investor is a defensive investor regardless of the circumstance, although a retired widow or something should not be taking on any more risk than she needs to. But other people have more options, for example. But regardless, the allocations should be the same for any type of defensive investor, no matter what your age or your situation. The rules of being a defensive investor stay the same, especially when it comes to stock allocations. The what you do with the stock portion of your portfolio, rather. Moving on, we have a statement talking very interesting that he brings this up, that doctors don't have time to be good at investing, and they're historically bad at it. It's funny. He saw people then, and I'm sure I know people now that have excessive amounts of savings they don't know what to do with. Well, why not play with it? Why not try to become even wealthier? He basically says, people that have higher incomes that can afford, that supposedly can take more risk because they can afford it, are generally really bad at it and should be defensive, again, unless they're willing to put all of the real time energy and knowledge into it. He says it takes a lot of work, and you have to do the work. You can't just go out there guessing. Now, regarding aggressive, I should write that in here, aggressive investing. Regarding in aggressive investing, there is a good quote here, that youth can stand these disappointments and profit by them. So finding growth stocks or whatever, anyway, to continue the quote, we urge the beginner in security buying not to waste his efforts and his money in trying to beat the market. Let him study security values and initially test out his judgment on price versus value with the smallest possible sums. Basically he's saying learn the ropes here, with small amounts of money before you start becoming too confident that you know what you're doing, and and I've heard this come from other very reputable, very successful investors as well, the fact that you kind of do have to make mistakes in order to learn from them. You have to lose money, and you have to be willing to lose money in order to learn. So, and I've gone through that a little bit myself. I've been lucky to perform as well as I have so far since beginning studying all of this about 5 years ago now. And to add to that, it's like, yes, I understand that this statement rings so true. You do have to learn, you have to make mistakes, and you have to learn from your mistakes. Very important to get to do this. Anyway, moving on, he repeats the I believe what he's saying here is that if you determine in order to determine if you should use higher risk of investing methods outside of being a defensive investor, it depends only on 3 things: knowledge, experience, and temperament. And you have to use all 3 of those things to be successful on anything that's not purely defensive. And we have a section on note on the concept of risk. And basically he concludes in this that nothing is totally safe regarding bonds and stocks, and it's important to realize that. And then we have a section talking about mentioning that about forced selling, and that there's no risk if you don't sell a paper loss. And he talks in this section a little bit about the fact that prices can go down, and as long as you're not in a position where you have to sell it because you need the money for this or that or the other thing, it shouldn't be a big deal. And that's part of the whole temperament thing. In order to be successful at investing, you have to be able to withstand dips. You have to be able to withstand when it goes down in price, whatever securities you have. And he mentions too, though, if the price is too high, it adds risk. It just, it can fall further if it's especially expensive. Again, we're very important to understand this. When he says price is too high, he's talking about earnings. He's talking about the price relative to its earnings. Then we address defining what large, prominent, and conservatively financed corporations are. Again, he doesn't get into the details of conservatively financed corporations. Again, this has to do with how much debt to equity that it has. Conservative, in the less debt compared to the amount of equity, that means it's more conservative. If more of the capital structure is sitting on the equity than the debt. But anyway, he says, as far as figuring out what's large and prominent, it's an arbitrary way of doing it, but it has to be, and you have to do it somehow, so here's the way to do it. And he basically gets to the point where he says that book value has to be at least the total market cap, including debt. So my understanding of this is the price-book ratio, which you can find on Yahoo Finance of any individual stock fairly easily. As long as it's 2 or less than 2, then that's okay. And then having to be 30%, I believe that would mean a PB ratio of no more than 3, if I'm not mistaken. Yeah, it would be about 3. And we have a point that what does large mean? It means that he does put a numerical number in there, and the version of the book in the link below, the PDF, has a nice footnote updating it for the year 2000, I believe. But I don't think that matters as much as this part of it. I think this is an easier way to calculate it out, and it's pretty easy to determine if a company is in the top 25 to 33% of its industry. I mean, these days, it's very easy to recognize. Most people know what the top companies are in all of the major industries. And if you don't know, you can look it up. Look up the ranking of it in terms of market cap, largest to small. What are the top 10 largest market cap companies in this industry is what you would Google. But along with that, there's always a but with Graham, and so he says, but it would be foolish to insist on this because it's somewhat arbitrary criteria. So if it's a little bit, if it's like below 30, the top third of the industry, it's not necessarily true that you should ignore it completely as a good investment for the defensive investor, obviously. And so, he says, just use your common sense, basically. And that pretty much sums up Chapter 5 of Benjamin Graham's The Intelligent Investor. Chapter 5, The Defensive Investor in Common Stocks. Hope you enjoyed. Thank you for watching. Rob's Child.